G'day everyone. My name's Ben and today I'm chatting about how to cut your tax bill before the end of financial year. Guys, if you could just throw into the chat, make sure my slides are coming through okay and audio as well. That would be awesome. Thanks, Vandana. Appreciate that. Great. So look, guys, obviously in Australia, we pay a lot of tax. So, you want to stay on the right side of the rules, obviously, but every dollar of tax that you save is another dollar that you can, save, invest, or just spend on your next holiday. So the rules can be pretty complex and confusing. So today I want to help you cut through some of that noise, figure out what the smartest options are. There's often a lot of different ways to be right with this as well. So instead of me giving you, the surefire, bulletproof 27 steps to get from where you are to paying $0 in tax. Instead, what I'll help you understand is the key areas that you should be focused on and the things that the questions that you need to ask yourself and answer to make the best decisions for you. Guys, as we're going through today as well, please chuck any questions into the Q&A as we go through. Feel free to throw any banter into the chat box as well. But I'm going to take some time for questions as we go through and answer as many as I can at the end as well. Guys, look, please don't rush out and make any life-changing decisions off the back of what we cover today. I strongly suggest you seek out personalized advice before jumping in. If you're making decisions around your tax, it's often things that have implications, not even just today, but for years into the future. So probably a good idea to dot your I's and cross your T's with that stuff as well. So look, before I get into the tax specific stuff, I think with sort of tax, but sort of just generally with your money that, I get that everyone's situation is unique, but there are some pretty common challenges that people face when it comes to their money and to tax. The three main ones that I see here are information overload. So it's like there's so many options out there, so much information. It's like hard to know who to listen to, where to be getting your information, who to trust as well. Like we're drinking from the fire hose. The second is that people struggle to really find a good balance between making smart decisions for their money, but also doing things that give them the lifestyle that they want and, give them the peace of mind that they want. And the third is the fear of missing out. Or the fear of effing it up, essentially, FOFU, which is a coined term that people essentially, you need to do something, but you don't want to do the wrong thing. And that fear can be paralyzing. So the end result is that you end up doing nothing. And what that means is that you're either doing nothing or just keep doing the same thing that you've been doing in the past, but you're missing the opportunities to be getting better results and getting more out of what you have now. So what I've found is that there's actually three main elements that you need to get right to be successful with your money, which is what I've got here: your structure, strategy, and solutions. Obviously, we're focused on tax today, but I wanted to call this out because if any one of these areas is missing, it ends up dragging down the others. So structure is about making it easy to save and manage your money, making it clear how much money you've got to work with. That ties into the strategy, which is all about understanding the different pathways that can take you from where you are to where you want to be. Buying properties, buying shares with franked dividends, negative gearing, tax strategies, all of those different things, so that you're really clear on the pathway that works best for you. And then the third piece is the investments that you use. And here you want to make sure that you're getting reliable, consistent progress over time, and that you're avoiding the downsides and setbacks and those momentum killing mistakes. As I said, if any one of the three areas is missing, it ends up dragging down the others. So if your structure is missing, it's like you're working with a leaky bucket. If you don't have a good strategy in place, you're leaving money on the table. You're probably leaving peace of mind and confidence on the table as well. And if you don't have good investments in place, you end up blowing up your cash. So not three steps, but elements that you need to get all of them right. And I'm going to give you a few things to think about in each of these areas as we go through today. What I've found, though, firstly, is just around the different stages that people go through with their money. And there's from talking to a lot of people and helping a lot of people with their money, I've found that there are 4 really clear stages that people progress through, essentially ranging from really not very good to, really good. What defines where you're at in the stages is 3 things. 1 is how quickly you're getting ahead with your money. 2 is your ability to live the lifestyle that you want. And 3 is how you feel about your money. So peace of mind levels, confidence levels, stress levels. So the first stage that I see people in is distressed. And that's where essentially you're making no financial progress, or in some cases, even going backwards. From a peace of mind point of view, you're stressed out, understandably. And from a lifestyle perspective, you're trapped because you've got no money to make the personal lifestyle choices that you want. What I've found is that you can't actually get out of that distress stage without making a real commitment to your money. So well done to all of you guys for listening in today, because money success is something that doesn't just happen on its own. It's one of these things that it's important, but it's not urgent. So it's easy for it to go onto the back burner and get put off for a tomorrow that doesn't seem to come around. So that's the distress stage. The next stage that I see people in is stalled. And that's where people are making some progress with their money, but it's slow and slower than they would like it to be. From a lifestyle perspective, they're able to make some of the personal lifestyle choices that they want, but it often comes at sacrifice of getting ahead financially at the rate that they want. And from a peace of mind point of view, they're not fully stressed out, but they do have that sort of niggling thought in the back of their mind that there's something more that they should be doing or something that they're missing out on. Next stage is comfortable. And for people in the comfortable stage, that's where we're starting to now build some good momentum from a financial perspective. From a peace of mind point of view, building a good level of confidence and finding a nice balance between the lifestyle side and getting ahead, like living the lifestyle you want while you get ahead financially at the rate that you want. Then the fourth stage is what I very technically labeled the killing it stage. And that's where you're now getting some really rapid acceleration from a financial perspective. No limits on the personal lifestyle choices that you can make. And from a peace of mind point of view, feeling completely carefree. This is a progression, and there are some key things that you need to do to progress through the stages. As I said, the first one there is making a commitment to your money. The second is about taking action and taking that action on an ongoing basis. And guys, like, I hope you get some great ideas out of the content that we talk about today, but ideas are useless without action. It's action that drives results. So you need to actually do stuff. You need to start that digital shoebox to keep your tax records. You need to implement that tax saving strategy. You need to restructure your portfolio, or whatever those things are for you, but you've got to actually do some stuff. And then also, because everything changes so quickly these days, you need to be taking that action on an ongoing basis. There's unfortunately, no good set and forget money strategies, because what's going on in the world, what's going on with your money, and what you want and what's important to you. Those three things, they're all changing all the time. So that means that you make the best decisions you can for today, but when the world changes in 6 months' time, or when what you want changes in 6 months' time, you need to make sure that you're still on the front foot so that you're making the most of what you've got and you're giving yourself the fastest pathway to where you want to be. The key to putting yourself in the best position possible, though, is about maximizing every single opportunity that's available to you. So squeezing every bit of juice out of your situation. And that's where this tax piece really comes in, because investing is one piece of the puzzle, but what we really want to be focused on when you're wealth building is the after-tax returns and outcomes that you're getting. So you want to make sure that you're optimized from a tax perspective. But beyond that, you've got to be doing the right thing with your debt, your investments, looking at the fees that you're paying, your budget, your bank accounts, like all of those things, because that's what gives you that rapid acceleration and serious momentum as well. And I'll give you some hacks that you can use in each of these areas as we go through today as well. No, for you guys watching in, like, if you can identify with any of the stages, I won't ask for any confessions in the chat, but I think it is a progression, and so it doesn't really matter where you are, that there's always something that you can do to improve on and build on what you've got going on today. So guys, first thing, I'm going to jump into some tax basics here. The first piece, which is really important to understand, is that in Australia, we work under a marginal tax rate system. Now, I've got the tax brackets here. So essentially, in Australia, the first $18,200 that everybody earns, you don't pay any tax on that money. Once you get above $18,000 and up to $45,000, you start paying tax at 19 cents in the dollar. 45 to 120 is 34.5%, 120 to 180, 39%, 180,000 plus is 47%. That includes the Medicare levy, just for the detail people out there. So one thing that confuses a lot of people when it comes to tax and tax rates is that they think that when they go into the next tax bracket, that they're going to be taxed at a higher rate on all of the income. That is not the case. What happens is, it doesn't matter if you earn $200,000, $100,000, $200,000, or $500,000 a year, you still pay 0% tax on the first $18,200 you earn. You still pay 19% tax on the income that you earn between $18,000 and $45,000. You still pay 34% tax on the next bracket. So there's actually no point on the scale whereby getting a bonus or a pay rise that you end up with less money after tax. Now, I have to call out one exception to this, which I got pulled up on by a financial advisor the other day, where I did a piece of content, and HEX is a bit of an exception to this, that if you have a HEX bill, because there are HEX repayment thresholds that you sometimes, if you go up into the next repayment threshold, you do end up having more tax withheld. But look, ultimately, your HEX bill, while it's annoying, it's something that does need to be repaid. So while you might end up with less in your pay packet, there is still more money that's being directed to your HEX debt to reduce that down, getting rid of the debt faster, essentially building your wealth as well. So that's really the marginal tax rate piece is important, because you only get, and I think I've actually got this in another slide, but you only get one tax rate. So you have one tax rate for your employment income. You have one tax rate for the income that you earn from your side hustle, one tax rate for the interest income in your bank account, for the dividend income from your share portfolio, for the rental income on your investment property. Basically, it all adds together to one number, and that number is your assessable income that you report to the ATO when you do your tax return. So there's not a different rate of interest, or not a different rate of tax that applies on interest income to dividend income to any other form of income. You've just got that one tax rate. But look, there are different tax rates for different entities. So you can own, when you're building your investments, you can own investments in your personal name, and investments in your personal name subject to tax at your marginal tax rate. You can also own investments in your super fund. And there's probably another conversation, but get that super money is trapped until you're old. So it's unlikely to be your first port of call when it comes to building your assets. But super has a huge advantage in that the maximum rate of tax that applies inside superannuation is 15%, which means that the tax rates are significantly lower than marginal tax rates, which means that if you're investing inside super, your investment's going to grow faster. You can also invest under a PTY Ltd or proprietary limited company. So any one of you guys that's listening in today, you could jump onto the ASIC website. You could set up, Jane Smith Investment Co. PTY Ltd. You get a tax file number. You can open a bank account under that entity. You can open a share trading account. You can buy a property in there. You can take out a mortgage, all of these things. And the maximum tax rate that applies on a company is 30%. Again, that can be significantly lower depending on what your marginal tax rate is, can be significantly lower. And then we've got trusts, which is quite a flexible vehicle, certainly not something that's for everybody, but it's same deal where anybody can set up a trust and you can invest through a trust. The key rule with trusts is that you're required to distribute all assessable income to another tax-paying entity. So it could be you personally, could be your partner, could be kids, although distributing to minors is not very tax effective under the current rules. But it could also be a proprietary limited company. And a trust gives a lot of flexibility. I'll talk about that in a little bit more detail, but gives a lot of flexibility because each tax year you can look at, well, who's going to be the best tax-paying, or which is going to be the best tax-paying entity to receive the dividend income from my share portfolio, and then you distribute to them, and it could potentially result in a much lower tax being applied. So where you invest is a really important part of cutting your tax bill. And it's something that can be difficult and expensive to restructure things over time. If you build $1 million share portfolio in your personal name and then realize, oh, actually, I probably should have put that under a trust or a company or a superannuation, you're going to have to sell shares subject to capital gains tax. All of those things means that it can be quite expensive and sometimes even not viable to restructure things. So, where you invest is a really important decision. I'll talk about that in a bit more detail in some of the considerations. You only get one tax rate, different tax rates for different entities. And For I've got a slide here for PAYG individuals. Investing is the biggest area to save tax. What I mean by PAYG is if you're a salaried employee, i.e., not a business owner, that investing is the biggest area to save tax. And what I mean by that is that if you run your own business or you're self-employed, that you do have some additional flexibility that's created in how you pay yourself. So you can run your business through a company or through a trust or through both. You can pay yourself wages, you can pay dividends, you can pay franked dividends, not franked dividends, you can withhold profits in a company. So that creates a lot of opportunity for saving tax. I actually just put some content on my TikTok the other day on this exact thing. Ben Talks Money on TikTok for anyone that's interested. And I got a comment back to say that this is why the country is ruined, essentially, which I sort of in some ways agree with the sort of the thought around this, although yeah, it does mean that, and the idea is that, like, for individuals, you do have less flexibility than, say, a business owner in terms of how you manage your tax and structure your incomes, etc. But what I said in this reply to this comment is that there are still a ton of opportunities that most people aren't taking advantage of that can help to really reduce and minimize your tax position. So while we can and probably should complain about the fact that there is a bit of inequality when it comes to the flexibility or the strategic abilities of individuals versus business owners, there are still a lot of rules that salaried employees can use to get better tax outcomes. And investing is a huge area. And as I've got here, the biggest area that I see in terms of an opportunity to save tax. Now, I wanted to illustrate with a bit of an example around investing in your marginal tax rate versus investing in underneath a company structure, just to give some context to what I was talking about there with the different entities. So what I've got is this example, and look, I've used sort of a few assumptions here, which I'll unpack, but essentially I've said if your aim is to build up investment income of $100,000 every single year, if you're earning a decent salary and you're somewhere close to or in the top marginal tax bracket, your investment income of $100,000 is going to attract tax of $47,000. Whereas if you have that in an investment company that has a maximum tax rate of 30%, but the tax that's applied is only $30,000. So you see that the difference here on an annual basis in terms of the amount of tax that you pay is $17,000. That's per annum. So every single year. So because what normally happens with most people when they're building wealth, it's like you're earning a salary, you're earning decent coin, you're socking away some money to build your wealth over here so that you can grow that wealth and eventually reduce or turn off your salary, or at least not be reliant on your salary to fund your living expenses. So while you're actually building your wealth, you generally don't need the investment income to live on. You just want that investment income to be growing to create your financial security for the future. So when you're reinvesting the money, you still need to pay tax on the investment income that you generate. So if you're paying tax at your marginal tax rate, it means that you're left with less, which means that your wealth grows faster. Now, if your aim is to build up to, say, $200,000, $300,000 or $400,000 of investment income, you see that tax rate that the tax saving actually accelerates. Got a comment there from Vic about the fact that, yes, you're right in that if your only income is $100,000, that your tax rate is 34.5%. But if you're earning a salary of $100,000 and then you get investment income of $100,000, that's going to push your assessable income well into the top marginal tax bracket. So that's what I'm saying, that if you're already there from your other income sources, yeah, you're welcome, Vic. If you're already there from other income sources, it's like the investment income is going to be taxed immediately at your marginal tax rate because you're already earning all of this other income from your salary and employment. So you see that this creates the opportunity to save tens of thousands of dollars every single year in tax as you grow your wealth and investments over time. And They're also worth calling out that the government have slated, and I'm not sure with the new Labor government and whether they'll muck around with this or not, but they've spoken about increasing the top marginal tax bracket to 30%. To the tax bracket on salaried income earned up to the top marginal tax bracket at a maximum rate of 30%. And they've also talked about lifting that threshold to $200,000. So basically, you can earn up to $200,000 of salary income without paying more than 30% tax. Then you build in the investment company, you're also paying no more than 30% tax. You can grow the income in the investment company and then pay yourself dividends or an income out of that investment company. And again, once your wealth is built, you're not paying more than 30% tax. So it's a really good strategy for long-term income and wealth building. And it can save you a huge amount of tax along the way as well, while we're still adjusting to those new tax rates that are coming in a few years' time. Investment tax, I want to unpack that and the key things that you need to be across there. I'm going to start with an example, though, that just talks about the power of compound interest and time to actually how quickly investments grow. Because I think a lot of people think when they're investing, they think that you need a huge amount of money to get started with your investing. Not necessarily the case. They also underestimate how quickly you can build your momentum. So what I've done is I've used a fairly simple example of saying that you save and then invest $1,000 every single month into the share market. So $1,000 a month, 12 months in the year, $12,000 over the year. Over a 10-year period, you would have put in a total of $120,000, but you would have got some dividends on your shares that would get reinvested. You'd also get some growth on the value of those shares. So in 10 years' time, like if you'd done this 10 years ago, your $120,000 that you put in would now be worth $190,000. You keep that going for 20 years, you would have put in another 120 grand, and then the value at the end is now, you see it's growing pretty considerably, $642,000. 30 years and 40 years, $1.7 million and $4.2 million. Guys, this is $1,000 every single month, which I get is not a small amount of money, but it's also not a huge amount of money. This is less than 5% of disposable income for Aussies. Maybe it's a little bit less than 5% with the inflation running wild like it is at the moment, but you sort of get the point that it should be achievable for most people. If not now, then at some point in the not too distant future. And if you can invest $2,000 a month, then every number here doubles. And you see that you can, yes, it is a long-term play, but you can create some really serious wealth from a zero start, like from a standing start over time. So yeah, it creates a huge amount of potential for wealth building over time. And part of the reason that I've included this here is to show you guys that when we're talking about being tax smart and you're talking about investing, that if you're committed to and behind this stuff, that you can actually build a significant amount of wealth reasonably quickly, which means that it's even more important that you're being smart and strategic with your tax so that you can hold on to more of this of your income, the after-tax income, so that you can actually grow your wealth instead of just paying more dollars in tax. What I want to do is unpack the different types of investments that you can use and then the tax implications and some of the considerations around this. Now, there's only 5 real options for you when it comes to building your wealth. You can buy shares, manage funds or ETFs, or use micro investing apps. I put them all in the same bucket. You can buy crypto, and there's a bunch of different ways you can do that. Feeling probably a little bit of pain if you've been involved in the crypto market in the last little bit, as I am. Property is another way to grow wealth. Superannuation, important one as well. And then the last one is trusts, and I'm going to unpack that in a bit more detail as we go through. With trusts, a trust isn't an investment. It's actually an investment entity that you can have other investments inside of. But outside of that, these are essentially the key options that you should be across when it comes to your wealth building and your tax planning. So with Australian shares, that the income return that you get on these investments, that, like the assumptions that we use around this when we're helping people plan with their money, is that on average, you should be getting about 4% in income and about 3% in growth from an Australian share portfolio over time. That means if you've got $100,000 in share portfolio, it should be delivering you an income return of around $4,000 every year and growing by about $3,000 each year. Now, what that means when you take a bit of a step back is that Australian shares, they're throwing off an income. The growth that I see at 3% is essentially a bit of like an inflation hedge, where long-term inflation, and obviously we're going through a high inflation period at the moment, but long-term inflation is around 2.2%. So 3% growth should mean that your portfolio is keeping up with inflation. And that means that it's really that 4% income that's your passive income from your portfolio over time. The thing with Australian shares, though, is, and the huge advantage of these over other investment types, is that they pay franked dividends. And what that means is that if you think in like the big banks, they report their record-breaking profits every single year. They pay tax. They make $5 billion in profit. They pay $1 billion in tax, or whatever that number ends up being. And then with what's left over, they pay out part of that profit to their shareholders in the form of dividends. Now, the ATO are kind enough not to tax that income twice because they've already taxed it at the corporate level. So when the dividends are paid to the shareholders, what you essentially get is a tax credit for the tax that's already been paid by the company on the dividend that you receive. The company tax rate for large companies in Australia is 30%. So what that means is that if your tax rate is more than 30%, is higher than 30%, you need to just pay a top-up tax. If you're in the top marginal tax bracket, that's 47%. So you might need to pay 17% tax on that income. But it's much lower than your full marginal tax rate of 47%. If your tax rate is lower than 30%, then it means that you actually get a tax refund for the tax credits that have been paid, and sometimes refunded in cash as well. In superannuation, because the maximum tax rate is 15%, when you've got Australian shares in your super that are paying dividends that are franked at a corporate tax rate of 30%, it means that the extra tax credits are refunded to your superannuation fund in cash, or a check, or bank transfer or whatever. But essentially, you get cash money back as a result. Now, I just did some writing on this just last week, actually, that when you in order to generate, I was looking at like generating an investment income equivalent to the average salary income in Australia, which is $91,000 each year. That to do that with unfranked dividends, so dividends that don't have tax credits attached to them, you need to have about $1.8 million in wealth. But with franked dividends, you only needed to have about $1.3 million in wealth. So you're essentially like $500,000 wealthier with the same amount of money, or you need less money, and therefore you're going to get to your like level of wealth that you want much faster. So it does make an enormous difference in terms of the after-tax return that you get on your investments. Also with Australian shares, if you're investing through an investment company that has a tax rate of 30% and your dividends are franked at 30%, you essentially get, you pay no additional tax. So it means that all of the dividends is received that can be reinvested, no additional tax, and your wealth just grows a bit faster. Got a couple of questions here, I think, on this. Ellie says, do international shares or ETFs attract franked dividends? So no, is the short answer on that. That basically companies that are outside of Australia, they probably pay tax in their foreign jurisdictions, but you don't receive a tax credit for that, the tax paid on foreign profits, essentially. So franking credits only apply to corporate tax that's paid in Australia by Australian-based companies. That's why I think both have their place. And I'm not saying because Australia is a really small market compared to the entire world, but they do have a huge advantage on that front as well. So I hope that helps, Ellie. Statistically, I got a question that says, statistically, is it more convenient, Is there a better return to invest in Australian shares or property in Australia? Well, so the long-term return on Australian residential property, including including the rental income return, is about 10.8%. That's about 1% on average of a property value in expenses each year, your strata, maintenance, insurance costs, property agents, etc. So that works out to be about 9.8%. The long-term return on Australian or diversified international share portfolio is about 8.8%. So the difference between them is about 1%, which is not huge, but it's also not nothing when you extrapolate that out over time. So the direct answer to your question is that property wins when you invest on a like-for-like basis. But here's the thing, when it comes to property, and I think I've got this on here at some point, but when you buy property, it's not like you get you save up $1 million and go buy a $1 million property. You save up a couple of $100,000 and then you go borrow money from the bank and then you go and buy $1 million property. So you've got a gearing benefit that comes with property, which means that it massively beats shares, because a $200,000 share portfolio, a good $200,000 share portfolio is never going to compete with a good $1 million property because the asset is 5 times the size. So yeah, there's the direct stats, but also the strategic piece there as well. I got a couple of other questions, which I might just circle back to them when we get to the question point, but those ones were around the specific Australian shares. So the key consideration with Aussie shares and with all investments is, where do you hold them? Do you invest in your name? Do you invest in your partner's name if they've got a different tax rate to you? Do you use different entities? Do you use superannuation? Crypto investments they generally have no income, certainly from a straight coin perspective. There are obviously staking protocols that come through that can generate an income, but essentially you buy Bitcoin, you buy Ether, you buy some other coin that it's a capital growth play, you hope. So there's no income on those. There's no franking credits when you stake coins in crypto because there's no tax paid in the on that income at a corporate level. So that's something to keep in mind as well. Unfortunately, like Terra Luna obviously happened. There's a big deal over the last little bit. We've seen a lot of people that have suffered like huge capital losses, but have big incomes from their staking stuff that's been paid. Unfortunately, those two don't balance out each other. Even though they've suffered a big capital loss on the capital side, they still need to pay tax on the income that comes through. So something to be aware of, because I think there's a lot of people that get caught short on this. Also call out with tax on crypto that I think people think that because there's it's like, you know, decentralized and potentially partly anonymous currency, that there's not necessarily going to be records, but I can tell you that the ATO is looking on this stuff. They will figure out a way to match up data eventually. And if you're not reporting on your crypto holdings, buys, sells, and everything in between, you're probably going to get a knock on your door or digital door at some point around that. Worth reporting. People also get confused when it comes to crypto, that they think if you put $10,000 into a crypto exchange and then trade through a bunch of different coins within that exchange, some people think that they don't have to pay any tax until they take the money out, but that is absolutely not the case. If you're switching between Bitcoin and Ether or any other coin, those are capital movements. So it's essentially like buying a share in CBA or selling a share in CBA and buying a share in BHP. There are capital gains implications of that as well. Property is a big one. There is a gearing benefit. So gearing just means, just to unpack a little bit of the jargon, it just means borrowing money to invest. So it doesn't mean anything more than that. If you borrow $1 and invest it into anything, whether it's property or anything else, that's considered gearing. When they talk about negative or positive or neutral gearing, that refers to the cash flow. So if the cash flow of a property investment is negative, then it's called negative gearing. If the cash flow of an investment is positive and you borrowed to invest, it's called positive gearing. If the cash flow is neutral, it's called neutral gearing. So the benefit isn't necessarily, I'm going to talk about negative gearing as a strategy, and I think that's a really good one. But the benefit when you buy property isn't necessarily the negative gearing or the positive gearing. It's just the gearing. The fact that you're borrowing to buy an asset that's 5 times the size than what you would have with your savings, that's where a lot of the benefit comes from. The negative part and the tax benefits that come are just cream on top. With property, though, there is a big difference between buying a property as an investment and buying as your own home. So that's important, both from a tax and strategy perspective and a cash flow perspective as a result. Really important. And look, with negative gearing, you do get to claim a tax deduction for the out-of-pocket expenses that you fund on an investment property. So if you've got a property that's there as an investment, basically anything that costs you out of pocket, with the exception of principal repayments on your mortgage, which is actually you reducing your debt and therefore not an expense, but that is a tax deduction, which is essentially refunded at your marginal tax rate. So I just put a piece out, which you can check out if you jump onto our mailing list. Essentially, to own a $1 million property in Australia, after negative gearing benefits, using the average return and income and cost assumptions in Australia, costs about $8,114 a year. But when you have property, the long-term growth rate on property in Australia is like 6.3%. I looked at the return from 1870, like from the year 1870, that it's been 6.3%. So if you've got $1 million property, it should be growing by like $63,000 a year on average, but it's only costing you $8,000. So that's a massive arbitrage. You're better off by like $50,000, $55,000 every single year. Worth noting that property doesn't increase in a straight line, but it is a super, super powerful strategy, and I think a really great one when it comes to wealth creation. You do need to be incredibly careful, though, when you choose properties, because if you choose an average property, you're going to get average and poor results overall. Deductions, though, from property are really helpful in reducing your tax bill, because basically all maintenance expenses, stuff that you need to do on the property, ends up being tax deductible. Also, with your own home property, there's also potential to debt recycle, and I'll unpack that strategy in a little bit more detail, but essentially change your non-tax deductible home loan mortgage debt into tax deductible debt over time. I got a question on property stuff, which says, how different is investing in a house compared to an apartment or unit? Yeah, look, I suppose it depends on the house or the apartment or unit, but the biggest driver of value and value growth in properties and price growth in properties is the land value. A pile of bricks is not that expensive. You can go buy a pallet of bricks from the place down the street for $500 or whatever a pallet of bricks costs these days. Probably with inflation, maybe a little bit more than 500. But essentially, it's not the property, it's not the building that's valuable. It's the land that's valuable. And with a house, you generally get more land than an apartment. That's why if you buy an apartment in a block of 6, you've got 1/6 of the land. You got more land. You buy an apartment in a block of 60, you own 1/60th of the land. Be a piece of land, but it's probably not 10 times the size. So you own a little slice, and then the bigger the apartments, the blocks, then it can be a dragger on your growth. So it's funny that the growth rates oscillate. One of the differences, obviously, in apartments versus houses is that they tend to, apartments will grow at one level, houses will grow at a different level. In COVID, we saw houses growing more because people wanted a bit more space. Now we're seeing apartments growing a little bit more because they're probably being a bit lagging behind. Broadly, they end up being around the same, but the land value is a big piece, because we are, increasingly getting higher density living, which means that the land is more valuable for us as a society moving forward. Super, I mentioned this already, but essentially income that's inside super, so dividend income, interest income, that's taxed at a rate of 15%. Capital gains are subject to tax at a maximum rate of 15% or 10% if you've held the investment for longer than 12 months. But the money is trapped in super. So as I said, it's not going to be your go-to strategy, but it can be a really effective strategy because of the fact that the tax rate is significantly lower. So one to be aware of. And sometimes with super, it's good to start small and then gradually ramp that up. Put in $10 a week or $50 a week or whatever that is. Then you get your pay rise and put a small portion of that. And before you know it, you've got more money growing in there. You can contribute up to $27,000 every single year, including the money by your employer, into your superannuation, and claim a tax deduction for that. So it can save you thousands of dollars or potentially even tens of thousands of dollars in tax utilizing that limit each year. Trusts, I've spoken a bit about this already, but essentially with a trust, you stream the income and gains. There is a cost to set up and then run a trust. So, it's probably going to cost you around $2,000 to $3,000 to set one up, about the same every year moving forward. So you need to make sure if you're going to use a trust that you're going to receive a benefit in excess of the costs that you pay. Obviously, otherwise it doesn't make sense. So, yeah, that's something to run your numbers. And if you're thinking about a trust, get some good advice, because it is important to get it right. There's a lot of great accountants out there, but sometimes accountants can be a little bit conflicted because of the fact that they get paid to set up and then operate these trusts moving forward. So sometimes get a second opinion, make sure that you're doing the right thing before you jump in. With trusts, you do pay land tax on property investments from $1. So for individuals, get an exemption from land tax up to $700,000 of land value. And then above, when you own more than $700,000 of land that's an investment, you start getting tax levied in New South Wales about 1.6% of the land value. So pretty considerable. Above 700,000, that's like $10,000 a year. So if you buy $1 million property inside a trust, you're going to pay land tax straight away around that $10,000 a year. So again, you need to factor in these costs, but the fact that you can get, this huge capital gain benefit, you get $1 million capital gain and you can distribute it to 5 people instead of 1 person, can sort of balance out, but it's important to run your numbers there as well. Can also use a trust in conjunction with an investment company where you have a share portfolio or an investment portfolio inside a trust, and then you distribute the income to your investment company, which has a maximum tax rate of 30%, grow investments inside the investment company, and then you sort of recycle them back through to pay yourself a salary through your trust in the future. If you've got really strong savings capacity or 6 figures plus in your portfolio, you should be starting to look at this, do your numbers, and it can save you a considerable amount of tax into the future as well. So worth looking at, but it's not for everybody. Look, in terms of some of the tax strategies that you should be aware of and thinking about to cut your tax bill, the first one is about deductions and keeping records. Understand your deductions. The ATO have a bunch of really helpful content on their website. Know what your deductions are. You also need to keep good records. It doesn't matter. I actually interviewed an accountant on my podcast yesterday, and we're talking about this, that even though you don't need to substantiate some deductions, they can still ask the question. This accountant actually used to work for the ATO, and if you claim $300 for your travel or one of those immediate deductions that they have, if someone asks you, you need to be able to tell them what that actually is. You can't just say, "Oh, I thought that was something that I could claim, or I didn't need to keep records." Like, you have to keep records. Also, the better the records you keep, the easier it is for you at tax time to just say, "Okay, yes, here are all my numbers." Bang, put it in, you know what your tax position is, and you just follow along with the bouncing ball from there. Private health insurance, if you don't have hospital cover in Australia, you pay extra tax above a certain income level. That means that if you're earning good money, that your hospital insurance is essentially free. So it means it's like 1% extra tax, can be in the thousands of dollars a year if you don't have this in place. So know what those rules are, and make sure you got the right thing in place there. As I said, you're essentially getting free health insurance and saving tax at the same time in the right spot. So understand that rule is an easy win for a lot of people. Franking credits, I already spoke about. So franking credits on shares and stocking them in your portfolio does make a really big difference from a tax perspective. So understand them, where they fit. Make sure that your Aussie share strategy fits in with your other investment strategy as well. But super effective and powerful way to drive a better after tax return when you do invest. Offset versus redraw is another one. This is where I've seen a lot of people go wrong with this stuff, but you really do need to understand the rules here, or at least understand that there is a difference between having an offset account and having a redraw. Where I see a lot of people go wrong is that they think that they're doing all of the right things, that you buy a property, you got a big mortgage, which you want to get rid of, that makes a lot of sense. Where you pay down the debt over time though, and you like the property, you form a bit of an emotional attachment, but then you want to move out and get a bigger property or a more expensive property or a property in a different location. but one that where you feel your original property was good and you want to keep that, if you've paid down the debt into the mortgage, into a redraw, and then you redraw it back out, because when you're redrawing, the purpose of redrawing that loan is to buy a property which is your own home, it means that the interest on that debt is not tax deductible. Whereas when you put money into an offset account and then you take it out of the offset account, the debt had always been at that level. It's just that the interest on the debt was being offset by the amount that you have in your offset account over here. The difference is, it's a little bit complex, but the difference is literally thousands of dollars in tax every year. So you want to make sure that you understand the implications, and essentially offset accounts give you more flexibility, not a lot of downside other than the fact that when you pay into a redraw, it reduces your mortgage payments each month. When you put into an offset account, it doesn't. But from the tax saving perspective, yeah, it makes a big difference. Negative gearing, I touched on already. So yeah, essentially, get the benefits of gearing, also get some tax deductions in the process, and accelerate your wealth building, reduce the after-tax impact of your investments. It's why it's really important, if you're looking to buy a property, that you understand, like, buying your own home will inhibit your ability to build wealth, because especially if you want your dream home in any sort of major city in Australia, that is going to be expensive. So when you're tying up a bunch of your cash flow in paying down your home mortgage, it means that you've got less money left over for wealth building. When you buy as an investment property, you get some tax benefits, yes, but it also costs you less to own the same property. And therefore, you've got more money left over for your wealth building. So tax benefits are cream on top, but yeah, I think it's a powerful strategy and worth just. There is a personal consideration in that, when you buy your own home, you can have a nice tangerine feature wall and do whatever you want, not have to deal with that annoying property manager. And I get that, but there is a difference in the numbers, and there's no right way, but you should understand what the numbers say so that you can make a balanced choice as to what is actually right for you. Debt recycling is another strategy. In fact, it's one of my favorite tax saving strategies, where it only works if you own the home that you live in. So you own your own home, which has non-tax deductible debt over time. Essentially, how it works is that if you've got a non-tax deductible home loan mortgage, you might have, say, you got $1,000 a month of spare cash flow. You pay it into that home mortgage. At the same time, you have a separate loan over here which is generally linked to your home. You draw the same $1,000 out and invest into a share portfolio. And because the reason that you've drawn that $1,000 is to invest into investments, that the debt interest is tax deductible. So what happens is, over time, your non-tax deductible mortgage debt reduces, your tax deductible investment debt increases, your overall debt levels stay the same, but you build this nice share portfolio, which should grow at a rate that's faster than your mortgage. Get some tax deductions over here, and you're paying down your non-tax deductible debt. So it's really a great strategy. And if you own your own home and you're investing in shares, you're making a choice. Do you either do it through a debt recycling strategy and get some more tax deductions, or do you not and get the same investment? So you need to make sure that you can structure the borrowing in the right way. And this is a strategy that's important to get good advice with, but it's almost a bit of a no-brainer for a lot of people that I speak to. So understanding, I think, is really important. Another one, and this is a really simple one, but leveraging the ATO timelines, that when you submit, if you're a good lodger of your tax returns, that you don't need to pay, if you're getting a tax bill, you don't need to pay your tax bill until May in the year after you lodge your tax, until after the financial year finishes. So for the financial year that finishes on 30 June in 22 days time, that you don't need to pay the tax that's due until sometime in May of 2023, which is a significant amount of time that you can have money sitting in your offset account or sitting in your high interest savings account, doing something with. Make that money work for you. On the flip side, if you're getting a chunky refund, then you probably want to get your act together and get your tax return submitted ASAP so that you get the money again out from the ATO and working for you. The best time for planning with your tax is in July. So the 1st of July, a lot of people start thinking about their tax in 30 June. And that, it's not wrong to do that. But when you plan on the 1st of July, it means you can be strategic for the year ahead. April gives you plenty of time to implement some strategies to get things sorted before the next financial year. So another good time to be doing that as well. Tax mistakes that I see people making, not tax planning before you invest. Investing is really, it's difficult, complicated, and expensive to restructure things afterwards. So tax plan before you invest, especially the more you're investing, the more important this is. So if you're doing, if you're investing $10 a week, it's probably not going to make a huge difference after tax. But if you're investing $1,000 a week, you should be getting good advice and good support, making sure that you've got your right strategy in place, because it's going to pay for itself many times over. Never invest for tax purposes alone, guys. If I can leave you with one thing, like, yes, the negative gearing is great because you get some nice, lovely tax benefits. But if a property doesn't work without the tax benefits that you get from negative gearing, it was never a good property investment to begin with. So I've seen a lot of people that they run into trouble with this stuff, depreciation benefits, and all of these things can be good, but those tax benefits should be the cream on top, in that your investment should stack up for without the tax benefits. Because the tax rules can change as well. So you can sometimes get blinded by tax benefits, start to cut corners on your investment choices. And as a result, then you make poorer investment decisions. Not keeping your records, I touched on, no set and forget strategy. And again, advice with an agenda. So can be around property tax or investments as well. Like if someone's got a conflict of interest, then it can influence the advice that you get. It shouldn't necessarily be that you really need to get that someone that's getting paid from a product or a commission, or an accountant that gets paid more if you set up a trust or not, is going to give you conflicted advice. But it should raise a few questions, and just make sure that you're doing your extra layer of due diligence in that case to make sure that the advice that you're getting is rock solid. When it comes to investments and property stuff as well, I believe fee for service is the way. Obviously, I'm a bit biased because that's the way that we charge, but where we charge a fixed dollar-based fee to our clients, where it's like, you pay this, and then we don't care if you invest in shares, invest through a trust, invest in your super, build money in cash, don't invest at all, buy a property. Like, it's just about making the right choices for you. So I think that can remove a lot of the question mark, at least in your mind, and go a bit of a way to avoiding average advice as well. Guys, I can see that there's a bunch of questions, and you can keep those coming through. I'm just going to quickly wrap on the planning piece, and then I'll crank into as many of those as I can. So look, I think when people think about their money success, they often think about it just as about choosing good investments. That if you want to get rich, you need to choose good investments, and you do, but it's only part of the story. It's really about investing, saving, your tax saving strategies, property debt strategies, risk management, estate planning, goal setting, keeping your focus, etc. So good success with your money is just about saving and investing, but great performance is about having clear plans, being tax smart, using good frameworks, right systems around your stuff, and getting the expert support so that you're getting the best results. Because without that support, you might get these good ideas, but you do have a lack of confidence to execute and actually pull the trigger on stuff. Don't know when or how much you should be pushing, and you miss opportunities, and ultimately you end up not hitting your financial potential and leaving money on the table. So, there's a whole process around planning where you focus on what you want, understand your options, explore what they mean, put it into a game plan and execute. And if you do it, and when you do that well and get it right, you can take confident action, take advantage of your potential, find a good balance between having your good lifestyle and getting growth, and ultimately, fulfilling your financial potential. So just before I get into the Q&A, I'm going to share this model with you that talks about where you guys are today and your progression to future state when it comes to your money. Essentially, when most people think about getting from where they are to this future state, they think of their progression like a straight line, but because of the compounding impact of time and money, it's actually a bit of curve. Essentially, in the future, you're going to be in a position ranging from not that good to really good. If you're not 100% on track to end up in the ideal position that you want to be in, you need to do some stuff. You need to jump the line. And when you do, then you just need to keep following the bouncing ball and take the next step and the next step and the next step. So if you leave it too long, you see that the jump that you need to take becomes more and more painful. The sacrifices that you take need to be bigger, and putting yourself in the best position can become impossible because the sacrifices are just too great. So the sooner you start, the easier it is to jump the line. And the more that you, the less that you need to do to actually get there. So I'll give you this quote from the man, the legend, Derek Sivers, that says, if information was the answer, we'd all be billionaires with perfect abs. And it's so true. It talks about the fact that you need more than ideas. Hopefully you got some great ideas today, but it's now about putting these things into action so that you can get results. Guys, to that end, I'll come back to the content piece, but obviously this is the sort of stuff that we help people with. In the chat, I've just popped in a link to our online calendar. We do this free 15-minute tax focus chat where we can talk through, you know, opportunities for you, give you a bit of no BS Q&A, and help you understand your next steps and how to get started. I've just popped that in the chat, which you guys should be able to access. If you want to take advantage, like obviously we help some people with this. If we think we can help, we can talk about how. If we can't, we can point you in the right direction. And I totally get that sometimes people just need a push to make that happen. That is just sitting in the chat for you now. Also, we do a ton of other content. You can check out our upcoming events with GA, also on our Eventbrite, Pivot Wealth website. Check out my TikTok. It's actually Ben Talks Money. I need to update that. And Instagram. And I've got a podcast called How to Be Successful with Money, which you can get around as well. Would love to see you there. And I've just got time for a couple of questions here as well. Georgie says, do you run any questions on just sole trader setups and strategies? Georgie, I don't, although I think that that's something that a good accountant should be able to help you with. So yeah, although feel free, if you want to drop us a contact through the Pivot Wealth website, if you want it, I'm happy to point you in the right direction on that, Georgie, as well. Chow says, property versus apartment, doesn't it depend on where the property land is, value of the area? There's a large shift in demographic. Yes, Chow, property investment, supply and demand. So an apartment in Bondi is going to probably perform better than an apartment in Goulburn, I would say, because highly desirable, limited supply, more demand. So you stick to those fundamentals, generally goes a wrong way. Liam says, what are the tax implications of putting into your spouse's super? Well, it depends on how you do that, but there's a few different ways and probably worth getting some specialized advice on this, but you can split your concessional contributions to your partner's name. There are no tax implications for that. Although if you've got a higher tax rate, it could be more advantageous for you to put the contributions in, and then you do this thing called spouse splitting where you push them over to your spouse. Guys, we've got a bunch of questions, but apologies, we are out of time. Hope you found that helpful. Check out, we're just about to launch the next series of upcoming events with GA. So check that out. Also, if you're not around their stuff, you should definitely do that because they're up to some pretty cool things. And guys, I will catch you on the next one. Bye for now.